Hey, what's up guys? Rob here. So for today's video, we're going to talk stock market lingo. So what's that mean? Well, what the hell's an IPO? What's averaging up? What's averaging down? All that fun stuff. So let's go. First, let me get started by moving my big head out of the way.
Vanish!
Come on, anyone remember that from Ninja Turtles? Okay guys, for this first slide here, we have some real basic information here. So we got buy, sell, bid, and ask. So buy and sell are pretty self-explanatory here. So buying just means you're taking a position. You're buying shares at a company, right? Now, if you're selling, of course, you're selling off shares. There's only really two reasons to do this. You're either taking profit or you're cutting your losses. Now, moving on to bid, think of itself just like going into an auction. It's the same scenario, right? What you're willing to pay.
$2 bill now, $1 bill looking at 2, 210 now looking at 3, 310 now can I get a 4, 4, but they're now sold. 400% bullshit round here.
Think of yourself as placing a limit order on Robinhood, what you're willing to pay for the stock. And ask is basically the opposite, what people are looking to sell their stocks for. Alright, so moving on to the next graphic here, we've got BidAsk Spread, bull market, bear market, and limit order. So BidAsk Spread, this is basically the difference between the highest price that a buyer is willing to pay and the lowest price that a seller is willing to accept. This is the de facto measure of market liquidity. Basically, the bid represents demand and the ask represents supply for whatever the stock is. And that juicy spread is what's in the middle. A bull market just means that everyone's expecting basically the prices of the stocks to keep going up. So actually, if you look at the graphic here, I didn't know this until kind of recently, like a week or two ago when I was kind of doing a little bit of research. So when a bull gores you, it lifts its head up. See the arrow going up? So it's lifting you up. Now, when we move on to the bear market here, so bear market is basically when you're expecting the prices of stock to fall. And what a bear does is it comes up and comes down on you and shoves you to the ground. So kind of how the down arrow falls. So that's how that's a bear. Moving on to limit order, if you guys watched my last video, one of the things that I said is that you always want to use limit orders. You don't want to use market orders. So if you're using a market order, you're going to end up likely paying someone's ask. So if you do a limit order, what that's going to do is make sure that if the stock hits that exact price, it's going to execute and you're going to pay the exact price that you actually want to pay. Moving on to the next graphic here, guys, we've got liquidity, trading volume going along and averaging down. So what is liquidity? Liquidity is basically how much cash you have on hand. That's how easy you can get in and out of a stock. I'm sure you've heard the term liquid assets before. So that's basically what it is. It's basically how much cash you've got or how much assets you have that you can move around quickly. Trading volume. So this is extremely important, guys. So this is basically the number of shares being traded each day. And you can see as stocks are being traded, you can see volume pouring in. The higher the volume, the more action is going. And generally, if you're looking to be bullish on a stock, you want to see high volume because that means a lot of other people are trading it and its price is going to go up. This is a great indicator for you. Going long means you think the company's stock will increase in price. So what you're trying to do is buy at a price that you feel is low, so that way sometime in the future you can sell it for a gain. So what averaging down means, guys, is that you've got a stock, but now the price is starting to drop and you're just buying more of it because you believe in the long term that the price of this stock is going to go up. So let's say you originally bought a stock for $5 and now it's at $4.50. So you started buying it at $4.50. So now this price of the stock is going back up. So you originally bought at $5. You bought the same amount of shares that you bought at $5 at $4.50. So now your average instead of $5 or $4.50 is $4.75. And this is a good strategy if you believe, of course, that the price of this stock is going to rise again. So moving on to capitalization or market capitalization, basically this is the total dollar market value of a company's outstanding shares of stock. So you'll typically hear this is referred to as market cap for short. The way that you get this calculation is you multiply the total number of a company's outstanding shares by the current market price of one share. So for example, if a company had 10 million shares and each of those shares are $100 each, you do the little bit of math and that means that company's worth $1 billion. So public float or float is another term that you're probably going to hear quite often, especially among traders. So basically what this means is it's just the amount of shares that are available for you and I to trade. So you take the amount of shares, subtract the insider amount, and this is what you've got. Unauthorized shares would simply mean the float plus the number of insider amounts. So it's the total actual number of shares out there in the world. And then finally, moving on to IPO. IPO is basically just a term for when a company initially goes public. So the very first day that a company's shares become available, most people will call that their IPO. And what IPO actually stands for is initial price offering. And there will be a bunch of requirements for a company to actually go forward with an IPO and be listed on a stock exchange. Now moving forward, you got secondary offering. That's basically if a company's stock's doing well, they may do another offering basically to sell some more stock and raise some more money. This can actually typically hurt a stock's value for investors because they'll go and some group will buy a ton of shares of some preferred stock, and instead of say paying what the value is right now in the market at 20 price, we'll find out that that company paid 12 price, and usually that'll shoot the price down of that stock. Now, blue chip stock, these are basically the industry leaders. So think Apple. I wouldn't even say Tesla because they're pretty volatile, but like steady stocks like Walmart, Apple, Microsoft, things like that, that are stable, and typically they offer dividend payments. And dividend we'll get into in another video in the future. Forex, basically that's foreign exchange. So that's basically trading different currencies for different currencies. So this is its own different type of market. Basically, it's just foreign exchange for currency. And next is hedge funds / mutual funds. So basically in a hedge fund or a mutual fund, you're basically giving your money over to somebody that's going to manage these funds. And they're taking your money and buying dozens, hundreds, or even thousands of stocks. And basically you're going to end up giving them some money based on you getting a return for your investment. If you want to get in a type of funds like this without actually going and hiring someone into the mutual fund, you can actually buy what's called ETFs in the stock market, which is coming up on the next slide. What's an ETF? An ETF stands for Exchange Traded Fund. It's basically a type of security that's basically a collection of securities, which basically are stocks that often trade on an underlying index, although they can invest in any number of industry sector or in various strategies. So there's a lot of different ETFs out there, and the different stocks that these ETFs are actually invested in all depend. So if you're interested in an ETF, you can look them up. An example would be stock ticker VYM, which stands for Vanguard High Dividend Yield. So if you go to, say, Vanguard's website, or you type in the stock ticker, you can look up and see what exact stocks that this ETF actually is investing in. So like I said, think of this as just a collection of a bunch of different stocks rolled into an index and then listed on a stock exchange. So an ADR is American Depository Receipt. It's basically a certificate issued by a U.S. depository bank representing a specified number of shares. And one share would be equal to that of a foreign company's stock. So basically by using ADRs, it offers U.S. investors a way to purchase stock in overseas companies that would not be available otherwise. So guys, beta, you probably won't hear this often unless you're getting into some technical analysis stuff. But basically, it's the measure of the relationship between the price of a stock and the movement of the whole market. So let's say a stock has a beta of 1.5. That means for every 1 point move in the market, that stock moves 1.5 points and vice versa. And then next, you've got a broker here. So a broker is a person or basically a business that buys or sells an investment for you in exchange for a fee. There are, of course, some brokers that don't charge a fee. A lot of them now don't. You've got Robinhood, Webull. Of course, I know TD Ameritrade adopted a no-fee clause, and there's a bunch of them. Now, they make their money in a bunch of other ways. Moving on, we've got day trading, which I covered in my last video. That's basically the practice of buying and selling a stock, the same stock within the same trading day.
Hey, fellas! Look what I found in my pocket! Look! A year's salary right here! What I call them? Fun coupons! See that? A fun coupon!
And like I said before, there's day trading rules. Unless you have a cash account or you have over $25,000 in your account, you can only do, I believe it's 3 day trades within a 5-day period. If you do more than that, your account can and will end up being suspended no matter what broker you use. Dividend. So I'm going to make a full video covering dividends eventually. But basically what this is this is a portion of a company's earnings that's paid to shareholders. The people that own the company's stock on a quarterly or annual basis. So let's say there's a company XYZ, they've got their stock and they pay a certain percentage dividend. So that they pay that percentage, like I said, every quarter or sometimes on an annual basis. And you can look up when dividends are coming for different stocks, and what you can actually do is snipe dividends. So you can buy in with stock, hold it for a little while, make sure you hit their cutoff for getting a dividend, and then you can sell the stock. Exchange is the same thing I covered in my first video. So there's it's basically a place where investments are traded. So in the United States, you've got your New York Stock Exchange and your NASDAQ. Execution. So when you order to buy or sell and it's been completed, that's basically an execution. That's all it is. It means it's been executed.
The time has come. Execute Order 66.
If you're a new trader, guys, do not use margin at all. You'll end up going in a hole real quick this way, especially if you don't know what the heck you're doing.
No! No, don't do it!
So what is margin? A margin account basically lets you borrow money. You're basically taking out a loan from the broker to purchase an investment. The difference between the amount of the loan and the price of the security is called the margin. Next, moving average. So a stock's price per share during a specific period of time, some time frames are 50 and 200-day moving averages. So you're just checking out the time frame that it's moving and you're finding an average in between them. A portfolio is just your collection of investments that you own. And a quote is just information on a stock's latest trading price. This is sometimes delayed by 20 minutes unless you're actually using a broker trading platform. Robinhood is even, I guess, somewhat decent in giving you a real-time quote, but there's other platforms which are a little bit better. And finally, we've got rally, sector, stock, symbol, and yield. So a rally just means that a particular stock is just going up rapidly at the moment. Sector just refers to a type of business that a group of stocks belong to. So for instance, Microsoft and Apple might belong to technology. You've also got communications, healthcare, financials, real estate, energy, etc., etc. Stock symbol is just a 1 to 3 letter character, basically, that is an abbreviation for a stock. For instance, if you want to look up Facebook, that'd be FB. And yield is simply a return measure for an investment over a set period of time, usually expressed as a percentage. Thanks again for watching, and please do me a big favor and smash that like button. If you enjoyed my content, please consider subscribing. Thanks, guys. See you in the next video. Bye.